You may have heard that the Fed recently cut the federal funds rate by 25 basis points. And if you're wondering how that's going to affect your finances, let's go. First of all, I've been asked, what's a basis point? Think of a basis point as a penny, except it's percent. So 100 basis points would be 1%. 25 basis points would equal a quarter percent. The next question I get is, what are the federal funds even used for? Well, it's used in a number of ways. The principal use is for short-term loans from either bank to bank or government to bank. So a reduced federal funds rate will reduce the cost of doing business for banks and has a direct correlation to the cost of consumer debt like car loans or interest earned on short-term savings accounts. So if you're thinking about buying a car, you may want to wait until after December 18th when the Fed meets again, as there's over a 70% chance of another rate cut. Another reason to wait till the end of December to buy a car is dealers are trying to get rid of inventory, so along with a lower interest rate, you may score a better price too. Another financial product that the Fed cut rate will affect is high yield savings accounts. The one I use is Betterment, and it went from 4.5% to 4.25% after this last reduction, which is still a great rate and much better than you're going to get at a traditional bank savings account at 1% or less. At the end of the list is the federal funds impact on mortgage rates. Mortgage rates are much more correlated to the 10-year Treasury than the federal funds. So keep in mind, as inflation goes, so goes the 10-year Treasury. And if inflation goes up, the 10-year Treasury goes up. As inflation drops over time, we will see the 10-year Treasury drop and mortgage rates will follow. If you find this kind of update valuable, follow along for more.